Thank you for joining us today for our Lunch and Learn series. I know that right now we're all in uncertain times as we experience this national pandemic, and I just want to say thank you to the healthcare professionals and first responders fighting daily to keep us safe. As an alumni community, we're here for one another, and I hope that each of you and your families members remain safe and healthy during this time. And so I just want to mention a few things regarding the webinar. Right now we have all participants muted and will remain that way throughout the webinar. If you have questions that you want Adam to answer, you can use the chat feature. And so we'll be monitoring that throughout the webinar. And after his talk, we'll take, I'll read questions from the chat for him to answer. We'll try to get through as many of those questions as possible. The chat will be monitored by our staff. So if you're having technical difficulties or anything else you'd like to mention during, please certainly use the chat feature. We are recording this webinar, so it can be posted later for other alums. And so just want to say thank you for joining us today. So today I have the pleasure of introducing Adam Dellemonico. He's a magna cum laude graduate from the class of 2017 with a finance degree. While a student at Rhode Williams, he was a member of the CAFE program, which is the Center for Advanced Financial Education, and he was also on the baseball team, just to name a few. Adam's currently a loan officer at Movement Mortgage, which is a national company with over 4,000 employees across 47 states. Adam has made a name for himself in a short time. He's consistently a top performer in the New England region and was the youngest to be named to the top 1% nationally among all loan officers. The second youngest loan officer to be awarded entry into Movement's esteemed President's Club, and was officially named the region's Rookie of the Year in 2018. So very impressive. Thank you, Adam, for being here with us. And as you can tell, we're lucky to have him here talking about the current market for purchasing or refinancing in this current market. And with that, I'd like to turn it over to Adam to talk a little bit more about the housing market.
Thank you so much for having me. It's always good to come back and give back to Rhode Williams. I really think if it wasn't for Rhode Williams, I wouldn't be in the position and have created the opportunities that I had. So thank you very much for having me. Super excited to talk about the housing market. It's one of those things that it's so in our face, it's so pivotal in everyone's financial plan, their overarching financial plan, but it's not something that is really taught or talked about in schooling, which, you know, it's just so important. And you don't really understand the process or know the process until you're going through it yourself. And then you're getting advice from people that you may have just met, may have found online. So I think it's crucial to just do a little bit of education on the housing market, the home buying process, the refinance process, just so that you're prepared to attack that before you actually do it. It is the biggest investment that you'll make. Real estate's the greatest creator of wealth. The most millionaires were created from real estate. So it's so pivotal to understand. And there really just isn't a ton of education around it. So that's what I look to do with my clients, is educate them on the process so that they're prepared when entering the housing market. Because realistically, when people think about buying a house, the first person they think of is a real estate agent. And while you definitely need a real estate agent, and I highly recommend using one when purchasing a home, they shouldn't be the first person that you talk to, because what you need to do is get pre-approved to go buy that house before you can look at it. The way that I kind of make the analogy is you wouldn't go shopping at a mall without your wallet. You can't go looking at homes without knowing what you're approved for. So that's really where I come in, is getting people pre-approved to buy houses, looking at their credit, income, assets, things like that, to determine how much house they can buy and if they're comfortable with that monthly payment. So that's what the lender's job is to do. So we're really going to dive into the overall financial picture of the person and the family to make sure that they're comfortable with what they're getting themselves into. So just to dive into that a little bit deeper, what lenders are looking at, there's three main buckets. It's credit, income, and assets. So we're looking at your credit score, your monthly debt obligations, just to see what you have already in terms of debt load. We're not going to overextend somebody. That's what happened in 2008. People were overextended. They ended up not being able to make their mortgage payments. And we all know what happened from there. So we're really going to make sure that we're not overextending people, because this is such a big investment. It's going to be your biggest debt that you have. It's also your biggest asset, but it's your biggest debt. So we really want to make sure that you're comfortable with the monthly payment and that you can afford that house. So we're going to look at your credit score, monthly debt obligations. We're also going to look at your income. Obviously, we need to see how much money you make to ensure that you can support this new massive debt that you're going to be entering into. And the last thing is assets, which is obviously just money in the bank for the down payment. So those three things is really what the lender is going to look at. We're obviously going to ask for documentation about that as well. But there is a lot of misconceptions about what you can do as a home buyer, especially as a first-time home buyer. The term 20% down is thrown around a lot. People think that you need to have a very large down payment, something like 20% to get into a home, especially as a first-time home buyer. That's not the case. There's low down payment options, little as 0 to 5% down, to really allow people to get into a home at an early age, because early home ownership, again, it's just such an advantage. It's such a great creation of wealth that, you know, these low down payment programs really allow younger individuals early get into a home. So especially in Rhode Island, I mean, rent is crazy everywhere, but the rent prices compared to what your monthly mortgage payment could be is pretty equal. So if you're around $1,500–1,600 for rent, that's a mortgage payment. And that's something that isn't often talked about. People don't think they can get into a home at an early age. I bought my first house at 22, so it's definitely possible through these low down payment programs. And again, if you're interested in it, you just have to reach out and talk to somebody about it. They can run an application. It doesn't cost any money to do it. And then you're going to understand where you set yourself up financially and whether or not you're there, or if it's a goal that you can reach to getting. So those are kind of like the high level overviews of what a lender is doing on the back end of the pre-approval process.
Great. Thanks, Adam. And I know in today's market, it has changed dramatically with COVID-19. So can you talk a little bit about how that has impacted the real estate?
Yeah, absolutely. So it's impacting every industry, and real estate is no different. Now, we are deemed essential in every state. So banks are still open, closing attorneys are still open, and for the most part, real estate agents can still go see a house, still go show houses. Luckily, well, at least with my company and most mortgage companies, we're very automated online. So most of the process can be done without any human interaction. So the whole mortgage process is online. You don't need to talk. You don't need to meet your loan officer in person to get the ball rolling, which is nice. Real estate transactions are closing virtually as well, which is good. So other than actually going to physically see the house, real estate is still moving forward. Now, obviously, you have to take other precautions because of, you have to be 6 feet away from people. You can't go in crowds. So like open houses are canceled and things like that. But real estate is still moving forward. And people who are looking to buy homes right now are in a really good position, because prior to COVID-19, it was a complete seller's market, meaning there was way too many buyers for the amount of inventory that there was on the market. So more buyers than there was sellers. So obviously sellers were getting more money for their homes because there was multiple offer situations. There were multiple buyers looking at every home. Now that's kind of inversed a little bit because there isn't as many buyers looking right now. A lot of people are scared. Unfortunately, a lot of people have gotten laid off. I think there was numbers 10 million unemployment claims, unfortunately. So there's less of a buyer pool looking right now. So the people that are shopping, that are looking for homes, are getting really good deals that 2 months ago they just wouldn't have gotten, because the supply and demand curve was way more heavy towards sellers, and now there's so much less buyers. It's a really good position to be in as a buyer. So other than the extra precautions you have to take just to be safe, real estate is still happening. It's still functioning. It's a really healthy market right now. I know a lot of people think that we're in a recession. We are definitely heading into a recessionary period, but not all recessions are the same. And whenever we hear recession, our brain just automatically jumps to 2008, because that was the most recent global recession that we had. And these two recessions are drastically different, especially in terms of real estate. 2008 was caused by real estate. It was caused by the financial markets. This recession that we're entering into is a health crisis. It has nothing to do with real estate. And historically speaking, home prices during recessionary periods, other than 2008, on average have increased 4.5% during the recessionary periods. So home prices, the housing market, it's very stable right now, just because rates are extremely low. There's still people that are looking to buy, and there's not a ton of inventory. So those factors all play into a really healthy market. In 2008, people were flipping homes left and right. Building homes was way too high compared to the demand. So when everything came crashing down, the supply and demand was way too heavy towards the sell side, meaning there was way too many homes on the market compared to people that could actually buy homes. That's not the case right now. So I feel really good about the outlook of the housing market. When this does pass, and I think everyone agrees that it will pass at some point, I totally see the real estate market booming and continuing to increase at a pretty steady rate.
Great. You talked a little bit about the outlook. What would the housing market look like 3, 6 months, a year from now? Will COVID impact any of that, or do you see it being a steady change?
Yeah, so it really comes down to unemployment. Like everything that has to do with the housing market is tied to unemployment. So it depends on how long people are out of work. The longer that people are out of work, the longer that they can't make their mortgage payment, get into deferment plans and things of that nature, the more pain that the real estate market will feel. If people start going back to work in a month, 2 months, 3 months, we're going to be fine. It will bounce back. But if people are out of work for 6 to 12 months, I think housing market aside, the whole economy is going to be in a really difficult position. So I firmly believe that if people start going back to work within the next couple of months, we're really not going to see any type of decline in home prices. And again, it's just because of the supply and demand laws. There's plenty of people that are looking to buy houses, and there isn't a ton of inventory on the market. So as long as those two things stay the same, meaning not a lot of houses on the market and a lot of people that want to buy houses, you really can't see a decrease in home values, which is really the only thing that the housing market cares about. So I think we're in a really good position, but again, it just depends on what the next couple of months come to find out, come to show. So we'll see what happens. I really do think it's going to be strong. Our economy prior to this was flawless for the most part. So I think we'll bounce back, but time will tell.
Great. And I know you mentioned a little bit about refinancing, and so that's a process that a lot of people may be considering right now. So could you talk a little bit more about that?
Yeah, absolutely. So the refinance process, we're really seeing a boom in that as of late. Rates are historically low. There was a time about 3 weeks ago, it was the lowest rates had ever been. And there was about $6 trillion worth of mortgages nationally that could have been refinanced with a benefit. So it is a very hot topic right now. It's super popular for people to be refinancing their home loans currently, just because there's a built up equity position since home prices have increased and rates are so low. So there's really 3 reasons to refinance. It's to lower your monthly payment. Obviously, if you're, just do a rate and term refinance to lower your monthly payment. Consolidate consumer debt. So if you have high interest credit cards are, typically 20% interest. If you have a lot of outstanding credit card debt, you can roll that credit card debt into your mortgage, which is typically a low 3 to 4% interest rate. That's a very wise financial decision. Or to do a cash out refinance, pull out some equity from your house and do a home improvement, add a garage, add an addition, something like that. So those are the 3 main things that I'm seeing as far as refinances. Rate and terms have gone through the roof because in 2018, which is, less than 2 years ago, a really good interest rate was 5%. And that was just where the market was. Now a really good rate is 3.5%. So a lot of people that purchased homes in the last 2, 3, 4 years are taking advantage of these low rates and saving themselves a lot of money. Also, the home improvements have a big one as well, because as home prices increase, so does your equity position. So you can tap into that equity, pull cash out of your house, and then, either, again, pay off consumer debt, do an addition, send your kid to college, whatever you may have. But it's a really good time to be in the market. Again, the mortgage world, the housing industry, it's really strong right now, especially for young investors. It's another thing I wanted to touch on quick. Young investors are I'm seeing come out of the woodwork, especially in Rhode Island. Rhode Island's a really unique market because of the home values. For example, like the 2 to 3 family market in Rhode Island is booming. So multifamilies. So that's what I started with. I bought a 2-family. I lived in one side and rented out the other. The term house hacking is thrown around. That's essentially what it is. You get tenants to pay for, over half your mortgage, and you live for, far less than what you would be paying for rent. It's an amazing time to do that right now, especially in Rhode Island. Multifamilies in Rhode Island are anywhere from 250 to 400,000, which, you're not going to get that in Boston or parts of Connecticut, but at least in Rhode Island, I'm seeing a lot of young early investors that are buying these multifamilies, living in one side, renting out the other, and it's just setting themselves up for great success later on. So all in all, the housing market super strong. Rates are low. Although we are going through this epidemic, this pandemic, people are losing their jobs. The housing market is one thing that I'm very confident will stay strong in all of this. Yes, we've seen a decline in the stock market. Yes, people are throwing around the word recession, but recession doesn't mean that the housing market's going to come down like it did in 2008. Because again, that was caused by the housing. That was the housing crisis. That's what caused the recession. This has nothing to do with the housing market.
Right. So if someone right now was, thinking about home ownership or refinancing, what would you say are the top 3 things for them to do in the next, let's say like a month to 3 months, in a short term, if they were really looking to move quickly on this? What are your top 3 tips for making that go smoothly?
Yeah. So the first thing is sitting down with your loan officer. That has to be the number one thing. They have to pre-approve you to make sure that what you're looking at is something that you actually are comfortable with and have the ability to buy. Because a lot of people think, okay, I just want to buy a $400,000 house, but the home price doesn't really matter. It's all about the monthly payment, right? Because that's what you live with for the next 30 years is the monthly payment. The price of the house doesn't really matter. So you're going to want to sit down with your loan officer to make sure that you know what the monthly payment is. You understand what gets rolled into the monthly payment, which is also taxes, insurance, things like that, and that you can actually afford it. So sitting down with your loan officer and getting them the documentation that they need in order to complete the approval. It's really not too much stuff up front. It's just like W-2s, pay stubs, things like that. But sitting down with a loan officer has to be step 1. If you want to prep yourself before sitting down with somebody, what I would say is take a look at your credit score. Credit Karma is a good free resource. I mean, it's not 100% accurate, but taking a look at your credit score and seeing where you're at. Typically, you want to have above a 640 credit score. You can go a little bit lower than that, but you really want to have a strong credit score before you enter into the home buying process. So taking a look at that and seeing where your score stands, and then talking to your loan officer would probably be a good step as well, just to make sure that you don't have a 450 credit score, because that's probably not going to work. But that's really the precursor to even sitting down with your loan officer, is doing a quick financial audit of yourself. After that, you're going to want to find a real estate agent. So crucial to have a real estate agent, just because there's so many disclosures, paperwork that goes on in the real estate process. If you're buying a house, the realtor is free. They're paid by the seller. The seller charges the seller's agent charges the commission to the seller, the person selling the house, and the buyer's agent gets paid by the seller's agent. So it's free to use a buyer's agent, and they're going to help you navigate the market. They're going to help you with the documents. They're going to know the local area that you're looking in. So getting in touch with a realtor would be the third step in that. So check your credit score, give yourself a financial audit, sit down with a loan officer, and then find a local real estate professional that'll help you navigate the transaction.
Great. Thank you. So I do see a few questions posted. If anyone has additional ones, please add it to the chat. Before I ask one of those questions, is there anything that you wanted to mention in addition, or you want me to just go to the questions?
I think you can dive into the questions. I think we touched on pretty much everything on how to get pre-approved, what the market looks like. Early home ownership is such a great goal for people that I think people think it's out of reach, but it's really not. It's really possible if you put yourself in a good position after college with a good job, start saving money. It's so doable. And so getting into the market sooner rather than later is just going to set you up for so much success down the line. And especially places like Rhode Island, it's so doable with where home prices are and from an affordability standpoint, there's nowhere better in the world to invest in real estate, in my opinion.
Great. So one of the questions, excuse me, is what are the average costs for refinancing, closing costs and other fees that go into that?
Yeah, so it's typically about 1% of the home price. So I'd say it should never exceed about $3,000 to $5,000 for like attorney fees, reissuing your insurance, an appraisal needs to get done. So I'd say $3,000 to $5,000, but typically what people do is roll that into their mortgage, so they very rarely come to the table with any money out of pocket. So it's far less expensive to refinance a house compared to purchase a house. But there is still some costs associated with it. Each lender is different, each attorney is different, but the main buckets are attorney fees, lender fees, and then homeowners insurance. And again, all of that stuff typically gets rolled into the loan. So it's not a fee that you pay out of pocket. You can finance that in.
Great. And then we have a question here asking, what % of the overall price is an average for a down payment?
Yeah, that's a really good question. So not 20%. Anywhere from 0 to 5%. I'd say typically 5% is the sweet spot. 5% on a single family home, and you can actually do 3.5% down on a multifamily. So if you don't own a house, if you're going to own or occupy the multifamily, so live in one side, rent out the other, you can buy it for 3.5% down. So if it's a $300,000 house, it's about $10,250, give or take.
Okay. And a follow-up to that is investing in a house a smart decision for someone that doesn't have a large savings?
So you do typically need to have some saving before you get into the house. So I would say get a little egg nest, because you don't want to be house poor. You don't want to spend all of your money in your bank account on the house, because once you get into the house, there's always going to be things that you need to do. There's always going to, furniture, small repairs that come up here and there. You want to have some CapEx fund, meaning some reserve account set up to be able to, handle the house. Because the worst thing you can do is get into a house and then something happens, like a water heater goes, and then, or a leak or something, and then you can't pay for it. You can't afford to be in that house. You don't want to put yourself in that situation. So I would recommend having the money for your down payment and then a couple of months of reserves for your expenses set aside. Just because it's such a big asset, you want to make sure that you are in a good financial position before entering into something as big as a house. But yeah, with 3.5% down, if you can do that on a multifamily, that is by far the best way to start investing in real estate.
Great. Another question here. How are lenders dealing with home mortgages now compared to pre-COVID? Have you seen lenders pulling back or upping credit checks compared to pre-COVID?
Yeah, that's a really good question. 100% across the board, every lender is tightening guidelines, just given the current environment of what's happening in our economy. And again, it's all tied towards risk, and risk is tied towards unemployment. So this is a very short-term guideline changes rather, but everything will go back to normal when people start going back to work. But for the time being, credit score requirements have increased. It used to be 580. Now most lenders are requiring 640. You now need reserves, meaning your down payment plus that small savings account in order for the lender to approve you if you have a lower credit score. Your debt to income ratio requirement has come down, meaning we can't extend people as much as we were before, which is all good things, and it all makes sense, because the last thing that the economy needs right now is for people to buy a home if they can't actually afford that home. If they end up defaulting on it or going into a forbearance, that's going to set the economy back even further. So all lenders across the board are having to tighten restrictions, tighten guidelines just right now. Once we come out of this, once people start going back to work, we came down from the top. Our CEO basically said that as soon as people start going back to work, we're going to go back to business as usual. But for the time being, we are tightening guidelines, and that's all lenders across the board.
Thank you. And there's a question here about, do you have a few suggestions on how you could bump up your credit score quickly?
Yeah, really good question. So the number one thing is your utilization rate for as far as quick credit increases. So with that, what the utilization rate is your credit limit compared to what you've charged on the card. You want to stay below 30% on that. So if you have $1,000 credit limit, you don't want your balance to exceed $300. That is the quickest thing that you can do. High credit cards, high credit utilization rates will definitely drag down your score. So paying that stuff off will be a quick fix for sure. Also, if you don't have a lot of credit, but you've never been late or anything like that, opening up credit is a way to increase your score as well. So opening up a credit card, using it for gas, using it for groceries, and paying it off each month, that's another really good thing to do, because that's what lenders are looking for. They're looking for how much credit you have and your ability to repay, and then also how long you've had it. So yeah, that's a really good question. Paying down credit cards and establishing credit if you don't have any, but obviously making your payments is number one.
Great. And I have another question here. If you wanted to buy more than one multifamily at a time for investment with 20% down, is there a site for these types of homes in Rhode Island? And what's the movement like for these multifamilies?
So auction.com is a good one for stuff like that. So that's a little bit more intricate as far as investing. If you want to buy multiple properties, it's 25% down on multifamilies for investment loans. So as long as you have the down payment money, if you have the funds to do that, you can buy as many multifamilies as you want, which a ton of people are doing. Where there's plenty of foreclosures, not a ton of foreclosures, but there are foreclosed properties that are on sites like auction.com that are super cheap, that definitely need work. And investors are scooping them up by the dozens. So it's definitely out there. That's a little bit more advanced real estate investing. So I wouldn't recommend that if it was your first home or if you haven't done it before. But there's plenty of opportunity out there for things like that. But it is a 25% down payment for investment properties, multifamilies.
Great. And a question regarding if someone was recently laid off, what's your recommendation on them preparing to then be able to purchase a house in the future?
Yeah, so we've gotten guidance from the agencies, which is Fannie Mae and Freddie Mac, and those are the government agencies that create mortgage guidelines. So what they basically instructed us that if you've been laid off due to the coronavirus and you go back to work, as soon as you're back to work, you're re-eligible to purchase a home. So they're kind of treating it a little bit like a maternity leave almost, where if there was a gap in employment for say 2 months, they would just take out that 2-month gap and then look at moving forward and then prior to the 2-month gap. So as long as you're back to work, you're going to be okay. Obviously, everyone understands what's happening, and this is kind of a make sense situation. If you got laid off because your company shut down, and now they've reopened, you're going to be okay to move forward with the home purchase as soon as you're back to work. But if you're not back to work, there's nothing we can do. Fortunately, I've had a few people that have been in process right now currently that lost their job, and we just had to press pause. And again, sellers are understanding of that because of everything going on. There's actually a new piece of the purchase and sale agreement, which is the contract that basically says if anyone gets laid off or there's a delay due to COVID-19, both parties agree to just press pause on the transaction until everything goes back to normal. So if you're heading back to work, you're going to be fine, but you can't purchase until you're back at work.
Okay, and let me scroll up here. So here's a question. In LA, they've made a law that a landlord can't evict a tenant for 1 year. In New York, they're about to write into law that a landlord can't evict until December 2020. Do you see Rhode Island putting something like this in place?
I hope they will follow Massachusetts. So we really just have to keep an eye on Massachusetts, because it seems like everything that Gina Raimondo does, it just follows, Baker. So I do think that there will be extra protection for tenants, but that's not to say you can just not pay your rent. It's kind of like the mortgage forbearance process, where if you can't make your mortgage payment, you can put your payment on pause. But as soon as you get back into the swing of things, you start working again, all that money's due. So especially, at least in Rhode Island, I have a couple rental properties. I've lowered my tenants' rent but they're still making rent payments. It's a contractual obligation still in Rhode Island that they have signed that they are going to pay X amount of rent over 12 months. I don't see that being forgiven. There will probably be something to help people out, but I mean, with the CARES Act, people are still getting money. They're still, even if you file for unemployment, you're still going to have I just saw something, you get $600 a week on top of your unemployment. So there's still funds that are available to people, to tenants who are unemployed. So I don't see that happening in Rhode Island. But if Massachusetts puts that into place, then Rhode Island will likely follow. New York has just been hit so much harder than Massachusetts and Rhode Island. Rhode Island has been pretty good with keeping the virus out. So I don't see that happening in the near future.
Okay. And then here it says, if you're in the home buying process now and you lose your job in 2 months because your company closes due to COVID, how are lenders working with those new home buyers suddenly finding themselves unable to pay their mortgage?
Yeah, so this is a very, very hot topic right now. That's the forbearance process, and it's putting a very big strain on the financial industry because that debt, that monthly payments is still owed, and so the servicer, the person that collects that money, which is the government in most cases, they set up their budgets, they set up everything based off of the notion that they're going to get that money. So with forbearance and deferment, it has to be an absolute last priority. If you're working, make your mortgage payment. If you have reserves, if you have money in the bank, but you're currently unemployed, collecting unemployment, still make your mortgage payment. The only reason to go into forbearance to not make your payment is if you don't have a job, you can't make the total payment, and you don't have any money saved, you don't have any reserves. That is the only reason you should enter into forbearance, because what's often happening is you enter into forbearance for 3 months, which means you don't have to make your mortgage payment for 3 months. And say your payment was $2,000 a month. What happens on the 4th month, which is in the fine print with a lot of these servicers, is on that 4th month, all of the 3 previous payments are due. So on month 4, you don't owe $2,000, you owe $8,000. So forbearance is an option. You have to talk to your specific mortgage servicer about their terms, but it should be an absolute last resort. It's either you enter into forbearance or you go late on your mortgage. If those are the only 2 options, then yes, enter into forbearance. But if you have reserves, if you have money in the bank and you're not working, it is very recommended to dip into those reserves and dip into those savings to pay your mortgage during this time.
Okay, great. It looks like we've got through all the questions. So if there's something you want to say in closing, please feel free to do that.
Yeah, no, I appreciate the opportunity. I just want to keep stressing how important it is to understand the real estate market before you jump into it. Again, it's such a great creator of wealth. It has really helped me see the big picture of, financial well-being. So I highly advise younger individuals to just show an interest in it, get into the market sooner rather than later, but do it intelligently. And the only way you can do that is by asking questions, by hopping on things like this and learning about it, because it's such a powerful tool that is often just not really taught in school or in college. So I really appreciate the opportunity. If anybody would like to reach out to me, you can share my contact information with the people that hopped on the call. But I'm located right in Providence, so I'm happy to help anyone or answer any questions later on.
Great. So I just want to say thank you to Adam for leading this great information session. It's always incredibly proud when we welcome back alums, especially having the rest of you join us here. It's great to be together, even though we can't physically be together. So just want to mention, keep an eye out for other upcoming webinars. We have a few in the works in the next coming weeks. And if you have any questions or any recommendations, or want to just reach out to let us know how you're doing, please reach out to the Alumni office. We're always happy to stay connected and to be a resource for you. And we hope that in these coming weeks, you and your family stay healthy and safe. And please keep us in mind if you need anything, because we're thinking about all of you. So thank you so much for joining today.
Awesome. Thank you. Thanks for having me.
Thanks.
Take care.